Good morning, everyone. It is Sunday, February 20th. I meant to do this video yesterday, but the day just somehow got away from me, so I apologize for that. So we'll do it now. I want to keep this video short. I just want to give you a kind of a perspective, a 30,000 foot perspective of the market and what I'm thinking about it and what I think we can expect going forward. So I want to start with a longer term chart. This is a 25-year chart of the S&P 500. And I want you to notice a couple of things that I think are important. On a high level, it just looks like the market goes up, which over time it does. But I want to point out a couple of things. I want you to remember, let's see if this drawing is going to work. Yeah, it looks like it is. If we go from that tech bubble that we had in 2000, we had three really bad years in the market, where the market was down 9.73 and then 11.75 and then 21.59. Pretty tough time in the market. But should you have gotten out of the market and given up on the market and said it's not the place to be? Well, you could, but you would have missed some pretty heady returns. We can also look at 2008. I'll draw this here. Market was down 38% going into the Great Recession, and you can see it went in here before it started to go back up in early 2009. And then had actually a very strong year following that. If you look at this, let me see if I can get a shape here. Bear with me one sec. Let's try this. If you look at this little area here, pretty big decline. That was in 2019. This is the COVID decline, which we all remember well, in 2020. And the reason I'm pointing those out is I want to show you that this is the decline that we're in right now. This chart is current up to Friday night's close. And even though when we're in something like this and the market is down about 8.5%, which is significant and that hurts, but that's not the year. That's just so far this year. This could turn around and be a stellar year. We just don't know. But my point is, over the long term, that doesn't look like much of a pullback or a blip relative to some of the other ones we've seen. I mean, this one was pretty significant that we saw that decline in 2008, the Great Recession. So I guess what I'm asking you to do is to keep your eye on the longer term. Inside the longer term, it is very normal, it is very common. It happens 2 to 3 times a year to have pullbacks or corrections that are 5 to 10 to sometimes even 15%. But what you don't do is you don't bail at the bottom, because that's what the market wants you to do. It's called a shakeout. They shake out the weak investors and then gobble up those shares. And that's what you don't want to do. If you clear the bottom, and this is what most individual investors do that don't have professional advice behind them, we've seen it 1,000 times, is I can't tell you how many people got out of the market between 2000 and 2002 because they said, you know, that's not the place to make money. It's just a scam, and it's just this and that. How many people got out in the Great Recession, and so on. That's what the market wants you to do, and that's exactly the wrong thing to do. So I just wanted to point that out, and hopefully that big picture helps just a little bit. I want to show you another picture that kind of goes into the technical analysis that I use on a daily basis, and some of you are enjoying that, and some of you don't really have an interest in technical analysis, and that's okay. Let me get rid of these annotations. So clear all drawings. Okay. So this is also the S&P 500. This is a daily chart every single day. And let me see something here. Again, I apologize. I'm not the best at doing annotations on videos, but here we go. So this is day to day, and this is a chart that I use. And you may see these things that say go and no go and different colors. That's because I have this chart overlaid with a technical analysis program, which is called Go No Go. And it's just one of many analysis programs that I use that actually color bars to help things be more visual. And we're in a no-go status. But that's not what I want to show you. What I want to show you is on January 4th, we kind of hit the most recent high in the market, which was right in that area where that little bubble is. And then on, let's see what day this is, on January 24th, we hit the low. And what I've done is I went from the high to the low. And what this box is this is called Fibonacci retracement. You've heard me talk about Fibonacci a number of times. And again, I encourage you to go to YouTube or Google, and if you'd like to learn about Fibonacci, because Fibonacci is not just in the market. Fibonacci numbers are found throughout all of nature, and it really is a pretty phenomenal, interesting topic. But anyway, this is what I do. Is I went from the top to the bottom, so you have to be off of the bottom before you know where that bottom is. And then I drew a Fibonacci retracement tool. And what that means is, I told you that it is very common that the market would gain and go back to somewhere between 50 and 61.8. The 61.8 is called a golden number in Fibonacci sequence. And I want to show you how powerful this is. It never, actually never ceases to amaze me. Let me get another little drawing tool here. The market responded, came back up, and went right to, look at this, it went right to 61.8, just a hair over. And then the market went down, and then the market went up, and where did it go back to? It went to 61.8. So you can see that 61.8 is a powerful number. It becomes an area of resistance. And once the market hits 61.8, it's very common that it then retraces, comes back down about 50% of the rise off of the bottom or somewhere in that area, and then goes to test that number again. And what we're looking for is a break on the upside of 61.8. Then we feel like that retracement is over and we're going higher, and we would have to break this line before we went into brand new high territory. So it is very common that it hits, retraces, hits again the 61.8 number. Now, this is an interesting point, because what we're looking for is the market's going to either break to the upside, and then the retracement is considered somewhat over, or 61.8 is going to act as a firm level of resistance. And that, unfortunately, is exactly what happened this time. If I go here and I take 61.8, I just draw that line, you can see that it acted as resistance. And it fell back down. Now, when a market falls back down and has a hard time the second time breaking through resistance, it is also not uncommon for the markets, it's called a retest of lows. And that retest of lows would mean the market could come back down to this level, which is the prior low, test that low. And when it tests the low, one of two things will happen. If it breaks below that low, it suggests the market's going much lower. If it finds support here and breaks back to the back north, back to the top, then once again, and what would be common is on the third try is to break through 61.8 and move higher. So we use, this is just one level of technical analysis. There are hundreds, but this one's been pretty powerful for a very, very, very long time. The Fibonacci numbers, and that's why, because money managers use it, they're looking at it just like I am all over the world. But you know, I wouldn't be surprised if we come a little bit lower. It does look like Russia is going to invade Ukraine. No one other than Putin knows for sure, but it certainly looks like in the next, I don't know, 48 to 72 hours, we're going to have an invasion, which is so sad and such a shame that that's going to happen, that one man can disrupt the world and people's lives like that. But in any event, I wouldn't be surprised if we retest this low and then it turns around and heads back north. Now, why should the market go up? The market should go up because our economy is very, very strong. The Federal Reserve doesn't raise interest rates and try to fight off inflationary environments unless the economy is extremely strong. And bear markets don't happen in those environments. Bear markets happen in recessionary environments, and we are nowhere near that. We've got COVID restrictions falling here in the United States and around the world every single day. Business activity is picking up. Inflation is up super strong right now, I think because there was so much pent-up demand from people being at home for the most part. So there's pent-up shopping demand, pent-up travel demand, pent-up eating out at restaurants demand, a lot of demand. And that's fine. A lot of demand is great for businesses. But when you couple that with supply problems, because remember, everything in economics boils down to supply and demand. It really does. So if you have strong demand and plenty of supply, then you're very, very profitable. I mean, that's great. But if you have a hiccup in the supply chain, which COVID also caused, that's where you get the inflationary fears, because you have so much demand and not enough supply, it pushes prices up. And that's exactly what we're seeing today. Will the supply chain loosen up? I have zero doubt. Of course it will. The supply chain will loosen up, and that will take a lot of the inflation pressures off the table, I believe. And so that's one good thing with COVID falling. Now let's look at war, because it looks like there's going to be a significant war in Europe, in Eastern Europe. War does not cause stock markets to fall. It may cause them to fall for a day or two, but it's very, very short-lived. And it's odd, but think of it this way. How does war affect a corporation, especially corporate America? Well, when you have a war, and the United States is not in this war, but the government is putting troops in Europe and doing certain things and spending money. When the government is spending money, that's actually good for the economy. And so I remember back when the Iraqi war started, inside the industry, we had, as we were leading up to that war, we had a phrase that said, "First bullet buy," meaning, the markets were very weak because there was a lot of news leading up to the war. But the day the war in Iraq started, the market went up, and went up very, very significantly. So will that happen here with Russia and Ukraine? I don't know. My guess is the market will fall just a little bit and then respond. But I think this market, based on everything that I'm seeing, I think we may have another very good year in 2022. I mean, we won't know until it happens, but we may have a very, very good year in 2022. I am in the process of making some minor / major adjustments into the way I manage the money. And I'll just throw a couple of thoughts out at you right now. One is, for those of you, and it's most, who own the defined outcome ETFs, the first thing you need to remember is, yes, your account value is lower, but you are protected between -10 and -15%. And don't forget, that protection only kicks in on the last day of the security's maturity. And these are 1 year or less maturities. So even though your account value is lower, that money, if on the maturity date of that security, if you're still down, you get that money back. So it's hard to see your account values lower on a day-to-day, week-to-week, month-to-month basis. But you have got to keep in the back of your mind that you have lots of guarantees going down 10, 15%, depending on which security I have you in. That's number one. Number two, I've decided we're going to get much more aggressive on taking our profits when those securities are within 1% of their cap. I've always tried to let them run their course because that gives you, in a taxable account, some tax benefits. But I've decided that I'm going to make an adjustment to that. If we get to within 1% of the cap, and we're within a fairly short time, let's say less than 3 months to maturity, if the market is in a clear technical bullish trend, I may let those ride so you get the tax benefits. If the market is not in a clear bullish trend, like right now, I'm going to sell those. And I'm going to take that money, you're going to realize a gain of the maximum gain for the security. That money will go into cash, into your money market account. And then the minute the market turns and we get a technical uptrend, which again, we don't have right now, we'll just go right back in and buy some more of those securities. So that's one change. It's a minor change, but I think it's going to be a very, very important change to help our overall returns. Another change that we're making is on the individual stocks that some of you have opted into. We're going to use much more dynamic stop management. The trick with stop management is you don't want it too close or you get stopped out, whipsawed, and then the market runs up and runs away from you and you miss those. So I have been working with some other money managers and we've created some thoughts about a more dynamic stop management program that I think will accomplish two goals. One, it will assure us that we never have a large loss on a stock. What's a large loss? I would say greater than 10%, 12%, maybe as much as 15%, but probably around 10%. It'll cap it there. And that we will have targets on our profitability and we will start taking profits at certain points. The whole goal is to avoid big losses. That's the goal. That's the whole goal. And if I were to go back to that other chart that I showed you just a moment ago, let me do that. Bear with me 1 second here. Let's see if I can. There we go. What we're trying to do in risk management in a big way is we want to avoid these. We want to avoid this really big downdraft. I will tell you, just because I have a memory of this, it was so recent, is from the high to the low, the market went down about 36%. And the average client portfolio that I managed went down about 15%. So yes, we lost. You're always going to lose. This happens very rapidly, but we lost a heck of a lot less than the market. If you remember, and you were with me back in 2000, we lost minimal, almost nothing during that big tech bubble. In 2008, yeah, we went down a little bit, but not much. We were mostly in cash in this area. So we're trying to eliminate the big catastrophic losses. The smaller losses, you know, even what we're in right now, which relatively speaking is smaller, those are just part of the market. That's just part of pullbacks in the market. And you have to have patience and you have to just ride through some of those things to survive. So a couple of changes that I think are going to increase our profitability and decrease our loss potential that are now in place. And I just wanted you to see kind of a long-term 36,000 foot or whatever they call that, 30,000 foot range of the market. And then finally, I wanted you to understand, whoops, that's not it, some of the technical analysis that we use to help determine if we're in an up market, if we're in a down market, and on a day-to-day basis, what some turning points might look like. So I hope that was helpful a little bit, especially for those of you who like technical analysis. I know some of you don't, and that's okay. But I wanted to let you know that I'm not in fear of having a catastrophic 2022 at all. And since I don't know and you don't know and no one knows, we will use technical analysis and we will do the best we can to make sure that we're protecting ourselves from any catastrophic loss. But you've got to be okay with small losses because that is part of the market inside big years. Last thing I'll say is I'm always available to do one-on-one Zoom calls to where we can look at your specific account, your specific securities and make decisions together as to appropriateness. All you have to do is let me know, and I'll remind you, if you go to my firm's website, fleetcapitalmanagement.com, you can always go to, I believe it's the contact me page, and you can just click on a button. You will see my schedule, and you can just schedule your time slot whenever it's convenient for you. I get notified immediately if you do that. It immediately shows up on my calendar. So please feel free. I'm always here. I know this is an uncomfortable time. It always is when we have a market like this. But I think we're probably a lot closer to the low than we are to the high. And again, at this point today, based on economics and everything I see, I don't have a lot of fear. And again, we're going to watch it. We'll follow the market. We'll let the market dictate what we're going to do. But we've seen these downdrafts before, and the people that get out at the bottom always miss this. So let's not miss that. And we have made some adjustments, and I think are going to be profitable for us. And we'll go from there. If you need me, I'm here. All you have to do is get on my schedule, and I'm more than happy to have a one-on-one so we can talk about it. Anyway, that's your Sunday review. And as long as the market is crazy, I'm going to try to do these once a week or once every 2 weeks, or as often as you need me to, just give you some assurances of what's going on in the market. Okay? Have a great rest of your weekend. Bye-bye.